higher rates, affordability at an all-time low, housing, still not enough homes for sale. We're not even going to hit 5 million sales for 2025. A new administration coming in. Feds have cut interest rates 100 basis points, and long-term interest rates went up, which has really never happened before. The consumer's still spending. The consumer's still traveling. I hear small businesses, restaurants, retail, things like that are hurting. Home prices still high. People have more equity in their home than they ever have before. Renters' average net worth is around $10,000, where a homeowner's average net worth is around $400,000. The market's still fluid. Fannie, Freddie, FHA, VA lending, non-QM is very strong. Being in the real estate business is tough. Being a home buyer is tough. Being a home seller is tough. That lock-in effect is real. The 2, the 3, the 4% rates people do not want to give up. I was even looking at a scenario recently where somebody maybe buy a step-up home, and just looking at the rates, and let's say they're at a 3% rate here in like San Diego, right? And I was like, oh my gosh, the payment is like 2.5 times that. So why would they do that? So as I sit here today in 2024 and I shoot this video, my monthly market update for December, which remember, so we always look backwards and ending the year. And as I shoot this, I'll be honest with you. Are we going to enter a new year? Is the next year just going to be similar to this year, which I think it will be? Are we going to have administration? And is there any way they're going to be able to fix affordability? Any way they're going to be able to build more houses? Are they going to bring down the cost of things? They're going to make things more efficient, right? Like the government, the housing, all that. Is there things that they can do without the Fed coming in and buying mortgage-backed securities, or without the Fed keep cutting rates? What about the spread between the 10-year treasury starting the 30-year fix? What about the loan level price adjustments that are on all these rates where Fannie and Freddie have had a record, I mentioned record profit. They made more money this year than they did in 21 and 22 during the refi booms. And where do we go from here? I'm excited to dive into the data to see how we're trending for this year, talk about some things that might happen next year, what I'm excited about, hot product like I always mention. But otherwise, we ended another year. And look, if you're a consumer watching this and you're renting and you want to buy, but I get it. It's expensive. Rates are high. Payments are high. Maybe you're not sure about your job, right? The job market is softening. You're not sure about the future. You're not sure about the new administration. Whatever it may be, we're all dealing with something, right? If you're in this business and you're watching this and you're a realtor, you're like, man, it's been tough. There's just not enough inventory. It's not inventory for buyers I have sellers that want to sell, but what are they going to do? They don't know what to do. They don't know where to go. So welcome back to another month, another episode. My name is Kenny Simpson. If we have not met, I'm a loan officer, a residential loan officer. I focus on 1 to 4 unit financing. I've been doing this over 20 years. Can you believe it? That's how old I am. Helped over 5,000 customers. That means I've done this over 5,000 times, helping people get loans. So I've become really, really good at it. Whether you're a first-time home buyer, real estate investor, right? Self-employed, whatever it may be, I'm here to help. I also put out content like this a lot. So if you see me, maybe you see me on a podcast, maybe you see me write a blog, maybe you get my emails, maybe you see me on social media. I'm passionate about helping the consumer. I'm passionate about educating you. I'm passionate about taking all that stuff out there in the world, all that noise, all that nonsense, right? Because it is crazy, and breaking it down. What does it mean for rates? What does it mean for real estate? What does it mean when they mention that in the economy? Like, what do we think is going on here, right? Are rates going to go up or down? And even though things are hard to predict, even though things are hard to even swallow, are kind of for people for us to sit back here and pretend that, oh, it's going to be great or this. It's really hard these days because we live in a crazy world where news is flying at us. Things change at a rapid pace, right? That's why a guy like Robert Kiyosaki will tell you it's actually a liability because it costs us money. We have to pay that mortgage every month. We got to pay the taxes, the insurance. Maybe there's an HOA. We got to pay the gardener, pay the pool guy, pay the electricity, right? Pay the gas. We got to fix that, fix this, maintain it. But what housing is proven to be in this country, in the United States, why? Because we have things like the 30-year fixed mortgage, right? Where people have locked in a 30-year fix. I mean, if you bought a home in 2017, let's say, and you refinance it and you have a 2.5% 30-year fixed mortgage, I mean, I don't think people, I was telling them at the time, do you even understand what you got? Again, my name is Kenny Simpson. If I can help you at all, here's my contact information. Please reach out anytime. For a homeowner in an early stage of foreclosure, that equity helps them avoid foreclosure sales, even by leveraging the equity to pay down past due mortgage bills, or by selling their property in order to protect the equity they'd otherwise lose in an auction. With recent home prices increasing, some people are worried about a new housing bubble, but mortgage debt isn't a concern. And lending standards are much better now than they were during the bubble. Consumer debt at record level. You guys can look at this chart. Consumer debt at record levels. Obviously, we know that because people took out a lot of debt when it was really, really cheap. But a lot of this debt, as you can see, is a mortgage, and 75% of that mortgage is at 4% or less, 30%, 3% or less. 90% of this is at a 5% or less. And let's go back to the previous things about the foreclosure, about the housing. I always mention this. Foreclosures are not even close to where they were. So that right now is not a problem. To get a loan is a pain in the ass for most of you guys would say that are getting a loan. Like, this is a pain in the ass. Even if you have a good experience, like it's not fun. It's like going to the dentist or doctor. I always say nobody really wants to do it. Mortgages is not sexy. So when you say that, then you realize it's a pain in the ass. In 2003, 4, 5, like, man, getting a mortgage is so easy. You just need a heartbeat and a pen and you can get a loan. Stated income, stated asset, 100% financing. This is easy. Well, folks, we're not even close to that. So if you're worried about a bubble because of that or anything else, right now in housing, we see nothing of that. Foreclosures is still low. Our lending standards are really high. Delinquencies are not crazy. So we're not seeing anything falling off a cliff. So if you're worried about that, don't worry about it. How are we doing for home prices? So home price forecast for 2025. I mentioned there'll be a couple of 2025s in here. As you can see, the average is 3%, and you can see the chart off of everybody else. There's a lot of people giving their opinions on this chart. And so you can see a lot of 4s, a lot of 3s, and some 2s, and we're going to balance out at 3. Honestly, my prediction is who really knows? It really is going to come down to rates, and we're going to talk about a little bit more how we can get rates down, how they can come down, and what might move them quickly as the new administration comes in. Home and equity outpacing debt. Yep. As of Q2 2024, we're at $13 trillion in equity. That's equity available, folks. That's what's available. So homeowner equity is $35 trillion. Sorry, $13 trillion is mortgage debt. Mortgage debt is $13 trillion. Let me back up. And then we have $35 trillion of equity. $35 trillion, folks. This is why people are in a good spot. They feel good. What's doing well? What do people need? 3 things that people feel good. They have a job, their house is up, and their 401k is up, their stocks are up. All that's happened. Like, it's crazy. Equity has begun to moderate along with broader home prices in recent months, but that's still the largest volume of equity we've seen on record, adjusting for seasonality. The average homeowner has $319,000 of equity in their home, of which $207,000 can be borrowed against while still maintaining a 20% equity cushion. That's insane. In October 2024, the U.S. housing market experienced a slight uptick in foreclosure activity, with 30,074 properties filing for foreclosure, making a 4% increase from the previous month, but a 11% decrease year over year. This nuanced trend, foreclosure levels remain relatively low despite monthly rising. So there you go. The number is very low. Right now, nothing to worry about, nothing to be concerned about. Home sales, there's your foreclosure. That's where it's all-time low because we remember we didn't allow foreclosures, but that's where it was in 2008, 9, 10. And this is where we are now. So if you're worried about it, go back and look. That's when we had a crisis. Total home sales forecast to rise. There it is. 2025 projections is 5.1 million. Current page 2024 is 4.6 million. So still under the normal. We want to be between 5 and 6 million. So not hitting it. So hopefully we can get those up. We need interest rates to drop so we can get people to buy, affordability, and the people to sell. That's what we're looking for. Existing home sales are down. Of course, we know that. Expired listings, days on the market up, inventory up, sales down. Okay, here's the 4 sellers options they're facing today. Relist with their current agent, relist with a new real estate agent, take the house off the market, list the house for sale by owner. So let's say you want to sell your house for sale by owner. This is very interesting. Why don't we give the data so you know? Should you hire an agent? Should you not hire an agent? I'm not going to pay the fees. I'm going to do it myself. Why don't you fix your car yourself? Why don't you fix your computer? Why don't you fix your plumbing, electrical? Why don't you do all that yourself? Why not invest your money, your 401k? Why not do everything yourself? No, just ask yourself that question. Why not sell your house? Because you don't do it that often. You don't know everything. Don't get me wrong. Somebody can sell their house and get lucky and it's all good. But the reason why people do not sell their house, number 1, it's most likely their biggest asset. Number 2, they really don't know what they're doing. Number 3, if a problem comes up, that's where it can cost you money. But at the end of the day, number 4, you're hiring a real estate agent because they're supposed to get you more money for your house or get you a better deal, guidance. You have that security. You got that comfort. They should bring value, confident, all that stuff. So don't think of it as, oh, I'm going to save money. Think of it as if you don't hire, it's a much more higher percentage that you're going to lose money if you don't hire. So I know you think you're going to save, but the agent that you're going to hire should be good enough to make your money back, make their money, their fee. They should be good enough to be able to provide that. Whether they ask you to do X, Y, Z, it doesn't matter. They should be able to do that for you. 90% of sellers sold with the assistance of a real estate agent, go figure, up from 98% last year. And only 6% were for sale by owners. The share of for sale by owner sellers was a historic low. I think that's good. Look, if you sold and and some people sell, and I get it, they've had the experience, cool. But if you have a job and a life and the kids and you're trying to do this just to save money and you think you are, wrong. I would not do that. For sale by owner as a percentage of home sales, there you go. Where for sale by homeowners found their buyers. 6% of recent home sales were for sale by owners this year. 6% of recent home sales were for sale this year. 4% of them knew the buyer. There you go. For 38% for all of for sale by owner sellers, the main reason to sell via for sale by owner was because they sold to a relative, friend, or a neighbor. What do you know? Most important reason for selling for sale by owner. Here we go. Sold it to a relative, friend, or neighbor, 38%. Did not want to pay the commission or fee, 30%. Buyer contacted seller directly. I get that. Did not want to deal with an agent. I get that. Seller has real estate license. I get that. Agent wasn't able to sell a home, 1%. Did not want to go deal with an agent, 9%. Seller was a license. Could not find an agent to handle the transaction. It was 0%. Other 3%. So those are your reasons why you guys are electing to sell. Top most difficult task for sale by owner sellers. Okay, here we go. Getting the price right, 17%. Selling within the length time of period plan, 13%. Understanding and performing paperwork, 10%. Preparing or fixing up the house for sale, 9%. Having enough time to devote to all the aspects of the sale, 5%. So looking ahead into 2025, what's the market saying? What are some of the experts saying? So let's see. Rick, founder and CEO of CJ Patrick Company. I don't expect to see a meaningful increase in the supply of existing homes for sale as home mortgage rates are back down in the 5% range. Housing inventory. How are we looking? Inventory has risen since 2021. So 2021, 565, 2022, 752, 2023, 738, 2024. This is October each year. 2024 is 953,000. New listing count, national, local market. So I think it's kind of typical. Pending listing count, median days in the market. You guys can see these charts, months of inventory. Days on the market has risen since 2021 as expected. Mortgage rates. Here we go, folks. Here we go. Serious mortgage delinquency rates remain low. Percentage of mortgage balances, 90% delinquent through Q3 of 2024. Holy Toledo, folks. That is low. That is a very, very healthy sign. This tells you a lot. You're paying your mortgage. Good job. That means you're employed. That means you have money to pay it. That means you're feeling good. You have equity in your home. Your 401k's up. Hey guys, you're making your mortgage. This is great. Obviously, a lot of you probably have low payments too. 2025 mortgage rate projections. Here we go. And think about it. Most of these are all wrong, so we'll read them. But just so you know, they're always wrong. Okay, Q4 of 2024. Fannie Mae 6.6, MBA 6.6, Wells Fargo 6.8, all three. Okay. Q1, around the same. Q2, around the same. Q3. So these guys are now, all these Fannie Mae, MBA, Wells Fargo, for example, they're thinking we're not even going to get rates into the 5s next year. That's what they are thinking. Interesting. Lower mortgage rates are expected to boost the housing market, but the lift will be modest given continued tightness in existing inventory and home buyers staying on the sidelines expecting further rate decline. Renters want to see lower rates. Homeowners are locked in want to see lower rates. They just want lower rates. They just need lower rates. Can we get some damn lower rates? Looking ahead to 2025, my baseline expectation that single family home construction is poised to steadily increase, bolstering by modest declines in the financing costs for builders and buyers and by scarcity of existing homes due to the mortgage rate lock-in effect. That's the First American chief economist. Let's chat, how to reach me, and let's end this video with a couple things. One of the hot products right now that I feel like is coming back around because rates are staying elevated as people are starting to look into the buy down options, whether they're paying 1 point or they're doing the 2-1 buy down. That's becoming more a topic of conversation as rates rise, as rates are not coming down as much as possible. So that's a hot topic. So keep that in mind if you're doing, FHA, VA, Fannie, Freddie, all that stuff. We have some jumbo products that will do that along this. So for example, today's rate 6.5%. You can do a 3-2-1 buy down. So the first year would be 3.5, second year 4.5, third year 5.5. And if you do refi before, that money that you paid into that, whatever that money is, some of that would get reimbursed back to you through a principal pay down when you refi. And if you have questions about that, reach out and we can always look at that and go through the details. But also, let's talk about mortgage rates. Coming in January 20th, when the new administration comes in the office with all these very, very smart people coming in and all these business leaders, it's going to be very interesting to see what they do. But the Department of Doge, there's going to be a lot of announcements. So I'm really going to be watching the data as we keep continuing to move forward. The data we watch to bring rates down, let me just give it to you. Number one most important data these days is jobs. Number two is inflation. Number three, I would say, would be something like consumer spending, economy, GDP, things like that. And then those are the top three things that we're going to continue to watch. Obviously, the 10-year treasury coming down, that can affect interest rates. The spread between the 10-year treasury and 30-year fixed, which was historically high, now it's low. But it typically, over 50 years, when things are not crazy like they are now, it's typically between 160, 180. We're sitting about 240. So rates could come down with nobody doing anything if the spread comes down. So maybe the administration comes in, that secondary market has the confidence, that could come down 50, 60, 70 basis points. That's one thing. Number two, the administration could come in and say, okay, hey, well, let's get rid of some of these LLPAs. Let's ease them. Fannie and Freddie doesn't need to make $20 billion a year each. So let's ease some of these. So there could be a case where you can get interest rates down a point without even having the 10-year treasury lower or buying mortgage-backed securities, things like that. So we're going to keep, but we are going to first always watch that data. That's what we're going to watch and see if it changes. If it changes, then we would start seeing interest rates drop because the 10-year treasury would drop. And then the second thing, we are going to see what this administration does, if anything, with rates and talking about housing and affordability and all that good stuff. Well, folks, thank you for watching. I hope you had an amazing holiday season. I know we're back in 2025. Hey, what's your goals? What's your plan? What are you looking to do? If I can help you with those, please reach out. If you want to just have a conversation about what product, maybe you need a refi, maybe you want to buy, maybe you want to buy an investment property, maybe you do say, hey, at some point today, I'm going to have to sell my house and move up to a trade up house, or I'm going to keep the house, pull some cash out. Maybe it's equity. I want to look at running that scenario. So there's many scenarios we can run. There's many different ways we can do it. I'm here to help. Thank you so much for watching. Hope this information helps. Hey, share this video with somebody that might be looking into buying, maybe confused about the market. And hey, you should be following me on Instagram. If you're found this video and you're not on my email list, you definitely need to get on it. So Instagram, Kenny B. Simpson. And if you want to get on my mailing list, go below in this video and either reach out to me or go to my website and subscribe to my email. And otherwise, Happy New Year's and looking forward to 2025. Thanks so much.